Gentlemen, welcome back to the channel. Here in this video, we are going to go over and look at some of the historical data behind September and the expected, at this point, well expected seasonal weakness. Now, I'm going to play a clip on CNBC from Ryan Dietrich as well in this video. It's about 3 minutes long, like nothing too crazy. But Ryan Dietrich says, we are still in a bull market, but seasonal weakness wouldn't shock me. Now, Ryan Dietrich has been so correct in markets in the last couple of years. He does not get the credit that he deserves, okay? So I do want to share that with you. We're also going to discuss why I'm so bullish on next year for broad markets with 7 different catalysts or tailwinds for stocks. But, well, really 8. I have to add one more in there. And why I'm specifically bullish on Tesla stock as well. Why I think Tesla could triple between now and the end of next year with a high degree of certainty on that. So hit the like button, subscribe to the channel if you have not done so already. Ladies and gentlemen, check out that link down below in the description of this video for the trading community if you have not done so already. Again, portfolio is up 80.57% year to date. We're outperforming 98% of hedge funds and institutions. And what we're doing is going out, finding the small cap AI stocks before Wall Street does. Wall Street just doesn't pay attention to a lot of the smaller companies, okay, until they get bigger and they have their moment. I like to invest in companies before everyone else does. Again, we bought IONQ at $7. It's in the 50s today. Amazon is buying that company now. Like, we were the first ones there. Bought Applied Digital at $3. Today it's 17. I bought Nebius at 22. Today it's 71. I bought Novartis Semiconductor at like $2. It's like 10. Okay. And we have a lot of those companies that have a lot of similar prospects as the other ones I just mentioned, that are severely discounted today. That is the strategy. By doing so, I also believe you lower the risk profile versus investing in Hail Mary, 10, 20, 30x stocks. I think if you can find the stocks that Wall Street is overlooking, you can get a similar return potential without taking on zombie-like company risk. Okay, that's the idea. Zombie companies, we do not invest in. But companies trading at a massive discount that are in AI that Wall Street doesn't know about, yeah, that is the best place to be capitalizing on the AI revolution, in my opinion. Now, someday, we will have a big correction, a big crash, and the well-loved stocks will come down, and we will seize that opportunity as well. But for now, this is, my view, the best area to be investing in. So come check it out. Link down below in the description of this video if you would like to. Again, not a recommendation. I'm not a financial advisor, and I'm not your financial advisor. Always contact one before making an investment decision and read the disclaimers carefully. With that said, let's get into today's episode. Start with some of this seasonal weakness, okay? Ryan Dietrich, again, on X. He's with Carson Research. They do some of the best history-based research out there. I really can't find anyone that can even compete with them. He says, yes, stocks gained this August. Still, here's a way to show just how weak September has been. The worst month since 1950, the past 10 years, past 20 years, and third worst in a post-election year. In fact, August and September have both been higher in a post-election year only 3 out of 18 times. So you could see, like, it is really bad, okay? Since 1950, it's the worst month. Okay, February is the second worst month. August is the third worst month. Like, August, September are just not good months, okay? Over the past 10 years, September has been the worst month. The past 20 years, September has been the worst month. And during a post-election year, September is the, again, third worst month. February is the worst month, and then August is the second worst month, and then obviously September is the third worst month. So there's a long history of September being a bad month. Now, things get a lot better, okay? Because October gets better, okay? It's the 7th worst month So it's almost in the middle since 1950. November is the best month since 1950. December is the third best month. Okay, so seasonals start to really improve. In the past 10 years, October is the third best month and November is the best month. Okay, so the past 10 years, there's a lot of seasonal precedents there. In the last 20 years, October is the fifth best month. So again, a little bit better than in the middle, but still close to in the middle. November's the second best month and December's the sixth best month. And then post-election years, October, again, the fifth best month. November's the third best month and December is the sixth best month. So again, September, historically August are bad months. Does it have to be that way? No. I point this out though, because the algorithms are programmed this way. Okay, there is one stock in particular that I have over $100,000 invested in the trading community. It's a small cap AI stock, fantastic company. Like 40% of the company is owned by insiders that work at the company. Like Citadel just bought 7% of the company, like without any premium. Like fantastic company. It's crazy that the stock is as low as it is. But why? Why is that stock so low? Because they IPO'd via a SPAC. So over the next 12 months after a SPAC, it's called the de-SPACing process. Okay. Well, they don't really have much of their own governing. Like the main, board of directors seat is the SPAC company. Okay, that took the SPACs public. Okay. Insiders cannot buy or sell. There's a lot of other smaller, requirements as well. But the historical performance of the next 12 months after a SPAC, the de-SPACing period, is so bad that Wall Street just doesn't touch those companies. This particular company, only about 5% of shares were owned by Wall Street. Okay? Crazy. Like literally they just don't touch it. Because of the poor track record. There's nothing innately different with a de-SPAC. Like there's some small requirements, things you have to do, but like that in and of itself does not drive down shareholder value, the de-SPAC. The historical underperformance of a de-SPAC leads Wall Street to stay away. Okay? You could use something similar for seasonality in September. The poor seasonal historical performance of September leads Wall Street to stay away. What it also does is it amplifies all of the bad news. It's going to make it seem like the smallest piece of bad news is like the end of the bull market. Okay, Friday's a great example. What happened on Friday? PCE came in line with expectations. Personal spending, personal income came in line with expectations. Trump ended the de minimis tax exemption. Okay, if you don't know what that is, really not a big deal. 75% of the entire duty exemption in the de minimis act was from China. Do you know that ended for China back in May? So we've already seen 70 to 75% of the financial impact of that in May. That only about 20 to 25% of that impact is going to be felt further from here. Okay. But yet the NASDAQ sold off over 1%. Like it was essentially a non-event. But with a poor seasonals in September and in August, that news is just overblown, over amplified. Like it was literally a nothing event. It changes none of the thesis on markets at all. It shouldn't even be factored in. But yet on Friday, we had a GDP report that, a new estimate for the Atlanta Fed GDP Now tracker that went from 2.2% to 3.5%. Let me read you this. It says, The GDP Now model estimates for real GDP growth seasonally adjusted annual rate in the third quarter of 2025 is 3.5% on August 29th, up from 2.2% on August 26th. After recent releases from the U.S. Census Bureau and the U.S. Bureau of Economic Analysis, the nowcast of third quarter real personal consumption expenditures growth, and second quarter real gross private domestic investment growth increased from 2.2% to 4.4%, respectively, to 2.3% and 6.1%. So the two most important metrics of how the economy is really doing, again, real personal consumption expenditures growth increased from 2.2% to 2.3%, and second quarter real gross private domestic investment growth increased from 4.4% to 6.1%. Okay. While the nowcast of the contribution of net exports to third quarter real GDP growth increased from negative 0.36 percentage points to positive 0.59 percentage points. Like on Friday, should have been a green day. These are exceptionally bullish numbers. These are great. Like, for an example, when tariffs first hit, like real gross private domestic investment growth was negative. Like, real personal consumption expenditures growth was negative. Like, there was real fear that that could lead into a recession. Now, recession looks far away from where we are today. De minimis exemptions ending, we already seen that in May. Like, it was literally a non-event. But again, just like a de-SPAC, Wall Street wants to stay away. The algorithms are programmed to stay away. They're programmed to not buy stocks. They're programmed to sell on any bad news indiscriminately, okay? There's not a lot of logic to what you see normally in August and September. It's a self-fulfilling prophecy. So, in fact, stocks could come down in September. Maybe as low as 620 on the SPY. Let's see what that would be on a percentage basis. That would be roughly a 4% drawdown. If that happens, great. You have a massive opportunity. Because the fact of the matter is, Wall Street is missing everything right now. Like, I'm so passionate about this one topic, okay? Where we are right now in time. Like, you need to lock in, bro. If you do not understand the opportunity that is ahead of us, the best investors in the world were visionaries, okay? If you want to make a lot of money in markets, you have to be able to see the future. You don't have to be correct about everything, but you have to be able to see the future. That's number one. Number two, as Stanley Druckenmiller says, which is pretty obvious, it should be to everyone. To make money in markets, you have to exceed expectations. If something is priced into a stock and the stock delivers what is priced in, you are not going to make money because stocks price in the future and they discount that till today. So basically, if, Tesla's priced in to sell 2 million vehicles, for an example, and they sell 2 million vehicles and EPS and everything else comes in line with expectations, the stock priced that in 6 months ago. It's not going to go higher on that. You need Tesla to excel on expectations, right? You need Tesla to over-deliver on expectations. And depending on how much over-excelling the stock priced in 6 months ago, or 3 months ago, or 2 days ago, is going to determine how much the stock goes up when positive expectations are exceeded, right? When expectations in general are exceeded. Okay, I know it sounds a little freaking complicated. It's not. It's not as complicated as you think. You don't make money based on what is priced in, okay? Now, stock goes up 100% beforehand, you need the stock to really, impress, okay, essentially. We've seen this time and time and again. That's the dumber way to explain it. But not just for a single stock, The same is true for the broader markets. Now, what I have here is my reasons to be bullish next year. And let me just add that other one, okay? And that's real estate, but we'll get to that in just a moment. Number one, rates coming down. Guys, before we even talk about any of this, you have to understand this is your moment. I don't give a rat's ass if you have $10,000 or $1 million or $200. This is your opportunity. This is your once in a lifetime opportunity. You will never get another opportunity like this one ever again in your entire life. It is so clear cut. It's almost stupid that Wall Street doesn't understand this. Okay? And hopefully you can just hear how convinced I am and how passionate I am about this, because I want all of you guys to excel your expectations, to beat your own expectations for yourself, okay? And you're not going to get another opportunity like this. Again, I'm not a financial advisor. I'm not a financial planner. I could be wrong. Come to your own conclusions. And after this presentation, let me know your thoughts on this down below in the comment section. But first and foremost, reasons to be bullish next year. Number one, rates coming down. This one is simple. We talked about this a little bit in the last video, but as rates come down, time horizons get extended. As we just talked about, you know, pricing in and discounting of the future, okay? It changes. It's not always constant. On any given year, Wall Street is not uniformly pricing out 3 years into the future or 5 years. Sometimes they're pricing fucking 2 days into the future, and sometimes they're pricing 10 years into the future. It depends on a combination of factors like how's the economy doing? How is the general world doing? How is, you know, is there a lot of uncertainty? Most importantly, where are rates? Okay, rates are a big function of this. So as rates come down, Wall Street starts to extend out their time horizons. Instead of paying attention to the next 1 or 2 quarters, they start paying attention to perhaps the next 1 or 2 years, okay? Or 3 or 4 years. The more rates come down, the longer that gets priced out. And again, as I just mentioned a couple minutes ago, like Wall Street will start to say, hey, what's the S&P going to earn 2 years from now? They're going to price in a percentage of that today. That's hence where you get markets going up as future expectations rise. But most of that correlation comes down to rates. Okay? Rates also affect the economy. Rates come down, economy gets stronger, earnings expectations rise. There's that aspect of it as well. Okay, number 2, big beautiful bill. No tax on tips, no tax on overtime, and tax changes. No tax on tips up to $25,000. That's going to help up to 80 million people. No tax on overtime could help another tens of millions of people. Call it over 100 million people could benefit with directly more money in their hands from this. What do people do? They spend all of their money. Pretty simple. Tax changes. A lot of people are not familiar with this. They're not expecting this. A lot of Wall Street is not pricing this in. But capital expenditures, taxes, okay? So now if you're a company, you can go out and invest in a new tractor, in a new semiconductor project, in a new XYZ, and write off 100% of that the first year, okay? Last year, it was 40%. So there's a larger financial incentive to invest in your business. And perhaps that is why you're starting to see the real gross domestic private investment go up so much. Again, 6.1% is a crazy number. That was reported on Friday. We covered that earlier in this video. Number 3, geopolitical conflicts ending. Again, as I said previously, a function of Wall Street's willingness to price out the future and discount that today or price it in ahead of time is partially what's going on in the world. Geopolitical conflicts ending? No, it's not as big as rate cuts, but it is a part of the bull thesis, okay? Things calming down. Again, war in Ukraine, there's always a chance that spills over into Europe. That's something that in the backhand is being priced in, okay? Number 4, trade deals getting done. This is significant, okay? Because once trade deals get done, good or bad, it creates certainty. Human nature is wired to not like uncertainty, no matter what it is. Okay, you would rather know the bad news than not know the bad news, or know the good news rather than not know the good news. Like me personally, if someone texts me and says, "Hey, we have to talk when you get here," and they sound serious, like instinctively, I don't want to have that conversation. Okay, whether it's like good or bad. Okay, humans are wired that way. There's no changing that. So getting certainty on trade deals is almost as big as getting rate cuts themselves. Now, again, there's the topic of conversation for cutting rates. Like, again, the economy needs to be strong or rate cuts are not a good thing. We'll talk about that in a moment. Number 5, strengthening economy. We already discussed this with the GDP numbers on Friday, but I think with Big Beautiful Bill, all of the things going on, it's clear the economy is going to continue to get better, okay? Confidence is going to pick up as uncertainty goes away. And really, the economy is a function of confidence, right? Like back in the day, okay? Again, I'm watching a show on Netflix right now. It's The Titans of Wall Street. It's about like the original JP Morgan and Goldman Sachs and Lehman Brothers, these big bankers. And essentially, like JP Morgan was the central bank back in the early 1900s. Like JP Morgan was the guy that bailed out markets when they got fearful. Now, back in the day, obviously the economy was smaller or whatnot, but it wasn't the problem that caused the problem in the economy. It was the panic from the problem that caused the problem in the economy. Meaning that the economy really doesn't go through substantial weakness anymore. The economy doesn't really go through recessions anymore unless there is a reason for people to panic. And we just don't have that reason to panic. Okay? So as long as nothing crazy happens, the economy is going to continue to strengthen because no tax on tips, no tax on overtime, tax changes, so on and so forth. Okay? Pretty simple. You don't really have to like read into it too much. It's just the way things are. Accept it and make money off of it or don't. Okay? Number 6, AI adoption / investment continuing. It's critical at this point that you have AI continue to be adopted and investment will continue. This is where the opportunity of a lifetime comes in. Because the fact of the matter is, AI is going to be the main theme of the markets for the next 10 years. If you were not investing during the dawn of the internet, well, AI is going to be bigger than the internet over time. And you are at the beginning stage of this. Okay? So eventually there will be another DeepSeek moment where Wall Street questions the capex of AI. But the fact of the matter is, AI is an existential threat to some companies. It's not optional. This will keep Google investing. This will keep literally all of them investing. There's just no other way. There's no other way to explain it. It is existential for some companies. This is not optional. Okay? So the party is going to keep going. Number 7, bearish sentiment is still extremely high. This is something a lot of people don't understand. But when people are bearish, that is exactly what you need for stocks to continue to move higher. Bull markets end when everyone is bullish. You could see in the latest AI investor sentiment survey that came out on August 27th, bullish investors at 34.6%, neutral investors at 26.0%, and bearish investors at 39.4%. This is a broad-based survey. A lot of retail investors participate in this. But if you look at hedge funds and institutions, as someone like Tom Lee has said, they are very bearish right now. They are scared. worried. They don't like Trump, okay? They don't like some of the policies. For one reason or another, they're bearish right now. They're bearish as hell, okay? Not a lot of Wall Street is like super bullish. Now, if you get on CNBC and you're a super bear, like that's not the right view. So you don't hear a lot of the bears, but the bears are very prevalent right now. That means there's more people to buy into this bull market, okay? You don't want everyone bullish, okay? Like, if you had a choice right now to snap your fingers and everyone was bullish, you wouldn't want to do that, okay? So that is a positive tailwind catalyst into the end of this year and 2026, okay? Now, number 8, real estate. This is something that nobody is really talking about right now, but there's record equity in people's homes. People may want a new home, but it's kind of unaffordable, right? So as rates come down, presumably affordability will go up for homes. People will be able to buy homes again, and real estate will start to move. People are gonna, sell their homes and have hundreds of thousands of dollars in the bank. That is going to boost the economy a lot, okay? My calculations could be $100 billion, $50 billion of excess money in people's bank accounts because of real estate alone. That is substantial. Is it a core part of the thesis for next year? No. But is it the cherry on the top of the sundae for reasons to be bullish? Yeah. Now, in my view, honestly, the only thing that could derail this market into next year is, again, some kind of deep-seek moment that is unpredictable, that comes out and scares people, okay? Which is, again, unpredictable, so instinctively low probability. Or Donald Trump just completely drops the ball and goes psycho, okay? And trade just does not go good with China. We don't get a trade deal. Trade embargo comes again. That is the biggest risk. It seems like we're moving away from that. Canada and Europe have dropped retaliatory tariffs on the U.S. It seems like a matter of time before we get trade deals done with them. China, definitely moving in the right direction as well. So it seems like that risk is getting further and further away. But hey, there's always the chance that things go bad. And that is the downside risk. That is something, a trade embargo with China is something that would actually cause a recession, if not depression, in this country. Like, there's no other way around it. America cannot just do business as usual without China. We are way too interconnected. So that's the risk, in my view. But I view it as a very low risk at this point because, one, I think Trump knows this. I think he knows the economical implications to do some kind of trade embargo with China. And I think Trump, like, low-key wants the best stock market, like, during a presidency. I think that's, like, a secret goal that Trump has, is to have that award or that personal stat or accolade for the best stock market during any presidential term. I personally don't want to fight that. And you could say Trump is like the most heavily invested president of all time. So he has a financial interest in the markets being healthy as is. Now, add all of that to this. The reasons to be bullish for Tesla stock next year. Okay, so all of that I mentioned is very good for markets, very good for Tesla. Okay, but Tesla specifically, number one, earnings estimates have room to move higher. Simple. People are bearish on Tesla. They're not expecting good things from Tesla. Earnings estimates have room to move higher. Number two, and again, like as rates come down, autos tend to be like benefited the most. As rates come down, people start to extend out their time horizon. Okay, keep in mind all of what we've talked about throughout this video. Number two, robotaxi not being priced in. This one is simple. We talked about this a lot in the last video, but like robotaxi is not priced in at all to Tesla. Tesla stock is trading lower today than where it was before the robotaxi launched, even though it's been a success so far. Like, Wall Street, for whatever reason, doesn't think robotaxi is going to be successful. That's clearly the wrong take. And throughout the end of this year, October, November, December, I think we get better and better news on robotaxi, more expansions, and Wall Street needs to start pricing that in, especially as rates come down. And then 2026, oh yeah, it's money. Like, there's almost no way in my mind that robotaxi does not start to be priced into Tesla. And the profitability potential for robotaxi is massive. There's almost no limit to where Tesla could go. Number 4, I believe there could be a quote-unquote refresh cycle where a lot of people bought Teslas 2018, 2019, 2020, 2021, 2022, even 2023, and they're like, hey, I want to get a new Tesla. Okay? There could be a bit of a refresh cycle. So upside to deliveries as well could come. Mix that with a stronger economy, more people that have more money. I think there's upside expectations to, again, not only earnings, but vehicle deliveries. Okay. And then number 5, Elon is all in on Tesla. So you're going to hear a lot more bullish Elon. You also could add here Elon's compensation package, right? All of that could obviously impact Tesla in a positive way as well. What you're really doing when you're buying Tesla is you're buying an auto company and you're buying into Elon Musk. Now, we know you're really buying an AI company. Wall Street doesn't realize that yet. As they start to realize that, you're going to see some big things. But you're buying into Elon. I don't think Elon's going to fail with Tesla. Okay? I don't think any of us think that. So it's really just a matter of time before Wall Street catches on and they realize the boat that is sailing away that they are missing out on. Okay? Which I think some of Wall Street has started to realize that since the launch of the robotaxi. Short interest is down about 9% in Tesla. The shares out on loan is down about 36.5% from Tesla. So a lot of Wall Street doesn't want to short Tesla right now. Okay? But, there's still a lot of people that don't like Elon, that don't like Elon's politics, that just don't like Tesla. And that is going to start to change more and more into the end of this year and in 2026. And that's where I think Tesla could triple next year, into the end of this year and next year. Because you're just not pricing in any good from robotaxi into the future. Like, Wall Street's paying attention to the next 1 or 2 quarters. When they start to really focus on the next 3 or 4 or 5 years, as rates come down, as the economy is strong, as earnings impress, as deliveries come in better than expected, that's where you get the triple. Because, again, the earnings power potential of robotaxi is massive. So let me know your thoughts on this down below in the comment section. Hit the like button and subscribe to the channel if you have not done so already. Check out the trading community if you would like to get involved with the group. Okay? Not financial advice. Read the disclaimers. You could lose all of your money. Okay? But I think my strategy is superior. And the fact of the matter is, nobody is doing this. Nobody has a strategy like this. It's like almost proprietary to myself, okay? Never heard of anyone doing this, but it's worked so incredibly well. I would invite you to come join us. The party is only getting started. Like, literally just got started. So, ladies and gentlemen, have a great rest of your day, and I will see you in the next one.